Good afternoon, boys and girls. Today we're going to be looking at a topic called forms of ownership. Now, this topic is asked from grade 10 all the way to matric, and there are a number of forms of ownership that you will need to be able to identify their characteristics as well as the advantages and disadvantages. So to start off with today, we are going to start with the most simplest and easiest form of ownership to start, and that is the sole trader. So the sole trader does not need to be registered with SIPC, which is the company's Intellectual Properties Commission. The sole trader may also be called a sole proprietor, and as I said earlier, it is the simplest and easiest to establish. We need to look at a number of different aspects within a sole trader. So we're going to look at things like capital, we're going to look at things like liability, we're going to look at things like legal personality as well as continuity. So you may not quite know what those terms mean, but I'll explain as we go along. So if we look at capital, only the owner can get access to a loan. In terms of legal entity, it means who is legally the legal persona or personality of the business, and in this case it is the owner. When we look at a legal entity, we say that this person or business must be able to do three things. That is, they must be able to sue and be sued, they must be able to purchase property, and lastly, they must be able to enter into contracts. Now, with a sole trader, the owner is the legal entity. So the owner can get sued and be sued. The owner enters into contracts. Even though he owns the business, everything is in his name. The business doesn't get sued, he gets sued, right? Now this links up with liability. Liability means who is responsible for all the debts in the business. Now with the sole trader is ultimately totally responsible for all the debts of the business. So if there is no more money in the business to pay the debts, the officer of the court can come and attach his or her personal possessions, such as their house or their car. So in this case, we say that the owner has unlimited liability. They are unlimited in terms of what they are responsible to pay in terms of all the debts. Then we need to look at a term called continuity, and this is, can the business continue to exist if the owner retires or dies? So think about this topic. It's called forms of ownership. So if Mrs. A owns a business and something happens to her and she passes on, right? Can she still own that business if she is not alive? No. So the form of ownership has got no continuity. There needs to be a new owner, a Mrs. B or a Mrs. C, who will then buy the business, or it might be given to them according to the will, but the name of the owner changes. So there is no continuity. The last thing we need to talk about with the sole trader is that the sole trader is taxed in their personal capacity. So we work with a progressive tax system in South Africa, which means the more you earn, the more tax you pay. So the maximum amount of tax that the owner could pay would be 45%. So that's really all the characteristics of the forms of this form of ownership. If you are in matric, I highly recommend that you still carry on watching, and if you are in grade 10 or grade 11, you may end the video now. So matrics, not only do you need to know the characteristics, advantages and disadvantages, you are going to be asked about the factors that contribute to the success and or failure of a sole trader. So the first issue we need to look at is what we call capacity. So capacity refers to the ability of management to start and to operate this business as planned. So with the sole trader, the success factor of capacity is that it is easy to control since it is a small business. It's owned by one person. The failure, however, is that it's difficult to continue and grow long term. It's difficult to get good, well-trained staff that are not expensive. The owner has to manage and carry out all the business functions. So those are the failures of capacity. When we look at taxation, The success factors are that the owner is only taxed on the profits in his personal capacity. So depending on how much income the owner earns, his or her tax rate may be lower than that of a company tax rate. If the owner earns below a certain threshold amount every year, no income tax is payable, and the business's profits are thus not taxed. However, the failure side is that if the profits get too big, he may end up paying higher tax in his personal capacity. So the failure by the owner to comply with personal income tax regulations could lead to substantial financial penalties imposed by SARS. If we look at capital, the success factors are that capital can be carefully spent and managed by the owner. The owner may be able to borrow money from a financial institution, especially if he or she has assets that can be used as a surety against a loan. However, the failure side of it is that the profits may not be large enough to actually warrant any expansion. And you cannot appoint people with large salaries because you do not have a working capital to pay for this. The owner is responsible for paying back any capital that has been borrowed. Let's move on to the next ones. Division of profits. That little lady standing there is all upset, and in actual fact, with this form of ownership, he or she should be happy. The owner receives all the profits from the business, which can lead to capital growing in the business. The owner may use the profits to expand the business, so these are all success factors. The failure side is that the owner needs to budget very carefully so that the business's debts are covered. If the owner does not make a profit, the income and livelihood of the owner may be severely affected, and he or she may lose all their personal assets that weren't even put into the business. The owner is personally liable for the loss of the business, so the profits may not cover all the business's debts. Let's move on to legislation. The success factors are that it is easy and inexpensive to start. There's unlimited liability may encourage the owner to work even harder to ensure that the business is a success. The failure of it is the fact that the owner has unlimited liability. Personal debts and business debts are one and the same thing, and the owner must comply with relevant municipal regulations or could be forced to shut down. If we look at management, there's one owner, so there are no disagreements. He can make quick decisions without having to consult with others. The negative side of this is that the owner has to do all the administration, management, and decision making in the business, and the owner may not have all the necessary skills to do this adequately. I hope that has helped, and I look forward to seeing you for the next video.